So, reducing mortgage risk, this is a really, really important area. And it's something, this is where a lot of people who have already built the portfolio end up losing the portfolio, running into difficulties with mortgages, dropping the market, their values go below, the amounts outstanding, rents decrease, and suddenly they can't service the loan. So, this is really, really important to the long term safety of your portfolio. So, reducing mortgage risk. Ideally, you'd have 6 months mortgage payments in your property business at all times, but 3 months is more realistic for most people. So I would advise you to build up some cash reserves so that you have at least 3 months, but better still 6 months covered of your mortgage. This means in a crisis you have time to plan a recovery. So at this very minute, we're in the middle of the coronavirus pandemic in Ireland. We Some banks are given payment holidays, some banks aren't because they're not traditional banks. Some tenants are paying their rent, some aren't able to, can't evict anybody at the moment. So it's a real, this stuff is really, really pertinent at the moment. So at least if you have 3 to 6 months payments and you have problems with the tenant or across a set of tenancies, you're going to have time to figure something out. I would also advise that you have multiple lenders to reduce the risk of one bank changing their criteria or leaving the market. But this is tough in 2020 when only one bank in Ireland offers interest only. So as previously mentioned, ICS, Dilisk are the only bank offering interest only at the moment in Ireland. So it's very difficult then to say you're going to go off and pay interest and capital just so that you don't owe all the money to one person. Ideally, you might have ICS and private lenders. So raising private finance is something which you will need to look at. In a perfect world, you'd have a couple of the banks involved in your portfolio so that if circumstances change with one, you're not fully reliant on them. Most people who have all of their loans with one bank, if they change anything, you have really no option. You've no relationship with another one in order to move it on, etc. Another thing you can do to keep your risks down is you'd ring fence something that's debt free and move it out of harm's way. You won't be able to do this in the beginning. What do I mean, move it out of harm's way? Well, you won't leave it somewhere that if another mortgage got into difficulties, the bank would be able to repossess that one or put a charge on it. In the beginning, you won't be able to do this because you'll need all the equity you have. Because the whole thing here is that we're going to be adding equity by buying rundown property, adding value to it, and that then refinancing, um, maybe using private finance initially, as we discussed, and then financing it onto the full term loan and getting your deposit back and using your deposit again. So in the beginning, you'll need all the equity you have. But when you're 5 or 8 years into this portfolio building, you may not be still adding to your portfolio. So there's a phase at which you're adding to it, and there's phases at which you're not adding to it. And what I notice then is that as people get older, they tend to get rid of the whole thing, which I'll touch on here, the best way to do that. So you'd ring fence anything that's debt free, which means you would put that somewhere else. If you had all your mortgages within a company and the company has limited liability, then you would take that thing that has no debt, put it away, or sign it over to one of your kids if you have kids, etc., within inheritance tax limits. You do not want to leave things there that are paid for, but the fact that you have other mortgages means that in fact they are all at risk if one gets into difficulties. The protections that you hear lots of talk probably in the media about what the bank can't do to you, and you may actually have a false sense of security in a way. Those all only apply to home loans, not to investment products. Um, what else can you do to reduce mortgage risk? So, what I find that in the beginning of their journey, people are so focused on where they can get the money when starting out, they rarely ask how will the bank treat me if I have any problems. They'll treat you very differently bank to bank, is the answer. So in Ireland, the main banks all have fairly robust systems to deal with arrears, and most of the main banks are fair. And the plus side of dealing with AIB, BOI, any of those, is they want your current account, they want your credit card, they want your car loan. So they cannot really suddenly change their tune completely unless you have serious, serious problems in your mortgage. Whereas some banks that lend are not retail banks, so they don't do current accounts, etc. and they're going to be taking quite a different approach if they have any difficulties with mortgages. Now, you'll have heard so much about the last recession and all the horror stories, etc. So, what happened after the 2008 recession is that the banks couldn't cope with the volume of problems, and the staff still had regular loans to deal with the admin. Now, they wouldn't have been doing much new lending, but with the same amount of staff. It's quite specialist work dealing with people who are in distress and are about to lose their house and can't pay. So, what happened after a certain number of years when they tried to solve these problems themselves and realised they couldn't, they started to sell the loans that were non performing, as they call them, to a vulture fund. So a vulture fund is a company, it's not a bank, it doesn't have to be Irish, so it can be a company from anywhere that comes in and buys loans. So they're not banks. They don't want you to pay them back month by month. They really want you to sell the house and pay the whole lot back because they buy and sell assets. They're the same now as a shop supplying any product. Buy them at one price and they sell them at another. But they're much, much more aggressive than a bank because remember, that's not who you took out the loan with. They aren't a bank. They're often not Irish, and they don't want the whole property. So they want assets sold and money in. We're lucky in a way that repossessions are very slow in Ireland, but do speak to an expert if you get into any kind of difficulties because you need to plan ahead. Um, the big thing to remember is that you have a contractual mortgage payment when you sign for the mortgage. And if you cannot pay it, you're in breach of contract. So that is quite serious in terms of what they can do to you when you're in breach of contract. So I know of situations where and I've dealt with situations where banks have told people who've maybe a contractual payment of €1,600, well, sure, if you can just give us 1,000 for a couple of months, and then they've gone and sold the loan without warning them. So do not underestimate how serious it is to breach your contract. You can actually call in the whole loan, not just the arrears that are on it. Why would they do that to somebody? Tell them that's just to pay because they know if they tell you that they're going to sell your loan, you'll probably stop paying completely. So it's an opportunity to get some more money in. It'll be in the fine print of the loan that they're allowed to do that they're allowed to sell it, but most people don't notice any of that. They just all they see is what they have to pay every month, and they don't read into the repercussions of it. They're not able to pay it. But if there will always be recurring recessions. They're part of an economic cycle. So if you need to be aware what will happen if you run into difficulty. So remember, if you have mortgages in a company, that company has limited liability unless you signed a personal guarantee. So if there's only 3 assets in a company, so say 3 houses, that's all they can pursue. If you have 20 houses in the company and some of them are debt free, they can pursue all that. But remember, if you keep the company too small, you can't use equity in all of them to raise finance in the others. So what do I mean by that? I mean, if you had 2 houses with 70% loan to values and then you had one with no debt, you would probably be able to borrow money off that other one to go and buy a fourth house. So once you remove your equity from a company setup, you can't use it. But normally, and mortgages would have a fixed charge over the property, which means they have a claim on it. You can't sell it without their permission, but also a floating charge over the assets of the company, so they can pursue anything else within the company which they want. So the danger of keeping companies too small or too big, I would be inclined to keep a couple of smaller size companies, and I'll also go on to why I do that in a little while now, why I would recommend that. So remember that within a company, you probably have limited liability unless you send a personal guarantee. Personal guarantee means they can come after anything you own, including your home, your car. But remember, if you have things with no debt, they're wide open. So if you have a company with only 3 assets, they can chase 3. If you have a company with 20 houses, they can chase 20. But the person who has the first charge has precedence. So if you had a company, you could have mortgage within a company with two different people. You could have one mortgage on one with AIB and another one with EBS. Now you wouldn't have actually because EBS only do home loans at the moment. But um, you can imagine it gets messy then because they have a first charge and probably a floating charge over the other assets. So if you go to change lender then and say I'm going to give the second one to Bank of Ireland or to ICS, they're going to see that the other people already have a floating charge. So you're going to be stuck a little bit with the one lender, I think, at the moment in Ireland, but it's not a situation I like because you've got all of your eggs in one basket. What's the safest type of mortgage? So the safest type of mortgage is a non-recourse one. What that means is the bank would only take back the asset if you couldn't pay and wouldn't pursue you for the balance at all. Self-administered pension funds, which are called SASs, have these type of mortgages. So it's a thing in self-administered pension funds. It's a condition that they're non-recourse loans. So they can't come after the rest of your pension even. Never mind your personal assets. They can't come after any of that, but they're only 50% loan to value and you have to pay capital and interest over 15 years. So you're not going to be able to, you'd need to have a good bit of cash flow in the company to do that. A good few European countries have non-recourse loans. So if you surrender your keys, they'll just let you walk away, even if there was 100,000 left on the short. PTSB in Ireland a number of years ago did a scheme like this, but they're not non-recourse loans, but they just invited a certain number of people who they couldn't engage with or were having difficulty engaging with, and did they want to surrender the properties and they'd let them off the balance. And lots of people were absolutely delighted with that because they were very worried about what would happen to the balance. Some landlords have buy-to-let mortgages and they don't understand that even if they give the keys back, the bank can chase any shortfall, including getting judgment on a family home. So lots of people who come to me say, well, we're thinking of just giving the keys back. They don't actually understand that that won't solve the problem at all. They're still liable for all the rest of the mortgage. So here's some terminology you'll hear in relation to mortgages, which if you don't fully understand could be a nasty wake-up call to you. So joint and severally liable means that if you have a mortgage with someone else, it's not that you owe half and they owe half. They can chase both of you for 100%. Now what will happen in effect is that they will pursue both of you because they'll know that one person has more means than the other. And eventually when they get the whole thing paid off, they'll stop chasing. But it still won't have been half and half because there could be receivers' fees, charges, interest, late dues. It could end up that you pay an awful lot more than what you borrow over the course of a legal proceeding. All of their legal costs will go onto your bill. And another one is an all sums due mortgage. All sums due means that they can call in loans that you haven't missed any payments on if you miss a payment on one loan. So that's obviously a really nasty thing to happen to somebody. They have maybe 5 mortgages, one of them is way bigger than the other, they get into difficulties on that or they lose their tenants. And all they're thinking on is trying to fix that mortgage, where in actual fact, all of the rest of them can be called in if there is an all sums due clause in that. So there is lots and lots to understand that people generally don't understand when they start off in property. So just beware of all of those things. Chat freely to your solicitor on them. Ask them what are the implications of me missing a payment on this. But ideally, the goal is get 6 months' payments saved up so that you have a real buffer when times get tough. Yes, at the moment, some people are being offered a payment holiday. I do think it will affect their credit. They're all telling them it won't, because they want to keep people calm, I suppose, at the moment. But I do think when they look back, they're more likely to lend to the people who didn't need the payment holiday than they are to the others. So that's reducing mortgage risk.